Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Ticker ZK, it's definitely on our minds today. We said we've got a theme of China this hour, and we're going to continue with that. Shares of Zeekr Intelligent Technology Holding, the high-end electric car brand under Geely Holding Group, rising as much as 40% after an expanded initial public offering. That's the biggest U.S. listing by a China-based company since 2021. And we're looking at Zeekr up right now, Tim, just shy of 33%.
Okay, so let's get to our roundtable because we got a great one. We got Amy Orr with us. She's Bloomberg News Equity Capital Markets reporter. You know, when we see her in our studio, we're talking IPOs.
It hasn't happened a lot in the last year or so.
But she's been busy with this one. Also with us is Bloomberg Intelligence Global Autos and Industrials Research Analyst Steve Mann. Steve, I do want to start with you because this is an IPO, but it's also a story about the auto industry, and especially comes at a really interesting time, given that demand for electric vehicles, especially here in the U.S., but also globally, is not what a lot of investors and a lot of analysts thought it would be in 2024. Talk to us about the timing of this company coming to market against these headwinds.
Yeah, it is very interesting. If you look at NIO, XPeng, Li Auto, all three are Chinese automakers listed in the U.S. They've been down 27 to 45% year to date. So the timing doesn't seem as very timely, but I think globally, auto sales are down, especially in Europe, in the U.S., but the Chinese are still doing okay. In the last couple of months, sales have gone up, and I think Zeekr, I don't think I have plans to sell in the U.S., maybe in Europe, but this is going to help build brand cachet for the brand locally in their home market.
All right, we're going to dig into that a little bit more because it sounds like they're gunning for Tesla because it's a little bit more of a higher end play. But hang on for a second. I do want to bring in Amy Orr, who follows the IPO market for us. Amy, as we mentioned, out of the gate, strong showing. How would you characterize this? And get into that Geely has indicated that it is going to subscribe to more than 90% of the stock. So they're going to own a lot of it, it sounds. So put it all in perspective for us.
Well, so to start off with, I would say that this is one of those deals that we've been waiting for a very long time because A is EV IPO, but it's also a Chinese company of sizable size that we haven't seen in a very long time. And so it's great that it's going up. And as you mentioned, like 90% of it was already sold like before it actually started the roadshow. So which is good to actually provide a good base and foundation for the stock to go up at a time when, like Steve was mentioning, that EV is not actually particularly kind of doing well across the board.
But does it show that Geely was a little, am I saying it right too? We had some debate. Geely. Okay. We want to make sure we've got it correct because there was a little bit of a debate in the newsroom. But is it a sign too that Geely was a little concerned about maybe the interest amid kind of the broader EV backdrop?
To be honest, I would say that just IPOs as a whole has been kind of choppy, and then particularly EV. And then given that at the time of the pricing, it was only 5.2 billion in market cap. And then now it's went up to around 7 billion or so.
But not the 13 billion they were talking about a year or so ago.
Definitely far away from that. I'm sure there were conservatism right there just to make sure that there is a good base, that it was not like 3 or even below. So definitely there is a bit of that, and probably also Geely wants to continue to hold a little bit more of that, looking at the future growth of the company, especially we're talking about this is the high-end side of the market. It's not the mass market that we've seen. Bloomberg has reported before that there were some headwinds there as well. So yeah, and how to go beyond the Europe market and beyond the Chinese market, going to Europe and other places as well.
So Steve, talk a little bit about that because it's kind of the perfect segue to what you cover as Bloomberg Intelligence Global Autos and Industrial Research Analyst. What exactly are the vehicles that are being offered? Carol did allude to the idea that they do compete with Tesla, but paint a picture of this company for a lot of people, I think, listening and watching right now who have probably never before today heard of this company.
Yeah, Zeekr is born out of Geely. It's the parent company, Zhejiang Geely. It's related to the 175 HK that's listed in Hong Kong. I mean, they offer two vehicles right now. One is an SUV, one is a sedan. It's a pure battery EV. It's selling at around 37 to 40,000 US dollar in China. That's about the same price as the Model 3 and Model Y over there. I think what's really unique about Zeekr and a lot of the Chinese brands over there is they're all considered smart cars.
Okay.
With great connectivity, apps that resonate with consumers. Very different consumer base over there. So I think they're going to try to export that type of offering to the globe, and I think listing the shares here, it's gonna help bring the brand cachet not only in China, but it's gonna get the name out there on a global basis.
Hey Steve, people hear Geely and they think, I think Volvo here in the U.S. Then maybe they hear Volvo, they think Polestar, which is an EV that is sold here in the U.S., a pretty high-performing one.
I was
for
in
the
a
folks.
Polestar out on the West Coast.
They're pretty cool.
Yeah.
What's the Polestar relationship with Zeekr? Like, can we think about it like a corollary?
Yeah, that's a good question. I think a lot of the design cues, that's in the Zeekr. A lot of technology within the Zeekr brand, EV brand, it's actually shared between Geely, between Polestar, and Volvo. And there's actually another brand called Lynk & Co. That's it's not available elsewhere, only in China. And so all those companies are actually related. Zeekr's R&D headquarters actually is in Gothenburg, Sweden.
Hey, listen, one more on the company, then I want to go back to Amy, but I do think about the Chinese EV market. How crowded, Steve, is it getting?
Oh, it's very crowded. It's a hyper-competitive market. As you probably heard, deep discountings been happening in the last year and a half, and it's interesting because the auto industry, the EV makers, the Chinese EV makers are very much vertically integrated over there. So they mine the lithium, they make the batteries, and then as well as the software. Quite different than how it works here. And I think in the earlier segment, you talked about tariffs in the U.S. And it's really necessary that the U.S. put these policies in place because to compete effectively with the Chinese, the auto industry needs to be much more vertically integrated. The supply chain needs to be much more vertically integrated than it is now. To really compete effectively with the Chinese.
Really important. You mentioned the price cuts, though. China's best-selling car maker, BYD, slashing prices across much of its lineup this year. So that is certainly the backdrop there. Amy, come on back in. An IPO market out at Milken. We talked with the M&A guys. They think it's starting to come a little bit more activity. The significance of this one actually doing well out of the gate. Is it something particular that it's Chinese, that it's an EV maker, or is it just kind of good to just see an issue come out and actually do well in its first day of trading?
Definitely, we just want any IPO to trade well at this point, I kind of feel. But then, like as a Chinese IPO, I would say that the biggest hurdle is not for a Chinese company to actually do well. It's really about whether the Chinese government is going to really release the kind of flood of Chinese companies waiting to actually get listed here. And
Is there a lot just waiting?
Definitely. And essentially, Chinese companies used to actually form the bulk of U.S. listings as well, and also the fact that I think Reuters, if I remember correctly, reported this earlier this morning that Shein is actually going for London as well. So essentially, these are the kind of headwinds, political headwinds that we're feeling that is going to hamper the kind of Chinese companies coming to the U.S.
So what are you watching in the next few weeks, in the next few months, as an indication from the Chinese government, from the way that investors receive Zeekr, that might indicate that we could see more IPOs from China-listed companies?
As Steve mentioned, that this company technically is not headquartered in China, but it's got very strong ties with China, that we always kind of see it as a Chinese company per se. But there are also quite a few, like I think Shein is in the same bucket as well, ByteDance in the same bucket as well, that they're headquartered elsewhere, but then we generally just see them as Chinese companies. But I don't feel that there is a floodgate being opened. Right now it's still kind of, trickle it's on a case-by-case basis.
Hey, Steve, just 25 seconds here. Joe Matthew tried to push the official over at Zeekr about Chinese government involvement in this company, in Zeekr. What do we know? And forgive me, just got about 25 seconds.
Yeah, it's actually a private company, Geely. So, there's Chinese government's always giving subsidies.
Yeah.
So, there are some ties, but it's a private company.
All right. Going to leave it on that note. Guys, thanks. We came at it from different sides, so appreciate it. Steve Mann out there at our Bloomberg Intelligence headquarters in Princeton, New Jersey. Steve is Global Autos and Industrials Research Analyst. And then right here in our studio are Amy Orr, Equity Capital Markets Reporter, as we said, watching the IPO market. This, as we see, Zeekr shares, they're up, Tim, roughly about 33%.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
As we talked about earlier, our Bloomberg exclusive about President Biden getting ready to hit hard on China EVs with tariffs as soon as next week. That's according to folks familiar at the Wall Street Journal doing some reporting on this as well, saying those tariffs could quadruple. So it's one of our big stories certainly on this Friday.
Yeah, Bloomberg News reporting today that China is losing its luster as a top country to invest in as firms seek to avoid geopolitical risks and turn to Southeast Asia and Europe, according to a survey by the European Union Chamber of Commerce in China. So we thought we'd get a perspective from Ben Harburg. He's founder and portfolio manager at Core Values Alpha. He joins us where it is very early in the morning in Beijing. The Core Values Alpha Great China Growth ETF, it's got about $8 million in total assets. It's up to about 6% so far year to date.
Normal people would be asleep. I'm just going to put that out there, Ben. Anyway, we appreciate you getting up. It is hard to get your head and hands around, if you will, China being investable today, especially on a day like today where you've got a very successful Chinese EV maker IPOing here in the United States. And then you've got, of course, what seems to be more tariffs coming on that market, pushback on Chinese-made goods coming to the United States, if you will. So having said that, why is China investable in your view? Because it looks like, there isn't a lot of investor interest.
I think you have to separate the tariffs from the realities on the ground and the scale and growth of Chinese businesses and the demand of Chinese consumers. So if anything, the tariffs are the direct result of the success of Chinese companies. If I were the Biden administration, I'd also be looking to bolster American auto industry support, if that's domestic subsidies in the United States, or hitting hard on Chinese exports because they're falling behind. The Americans simply don't have that kind of vertical integration that the Chinese EVs and the kind of the case study that we're talking about have. And so the net result of all that is I think that actually belies a really strong Chinese market and a significant threat to incumbent interests across a lot of the key verticals. One would say that, for instance, a lot of the pushback against the likes of Tencent or TikTok is again driven by the success it's had against incumbents like Meta or Snap or others. So I wouldn't look too deeply into tariffs to explain the challenges facing the Chinese market, only that they might ultimately scare away some investors who see that type of headline risk.
Ben, is that the way that this is presented in Chinese media? Is it the way that you view it within China, that these tariffs and the reaction that lawmakers here in the U.S. have to TikTok parent ByteDance is the result of success of those companies?
I think they do. I think they perceive that. I mean, and there was leaked internal audio from the likes of Mark Zuckerberg, who were just simply stunned by the success of TikTok against his platform, and even tried to create a replica named Lasso that just absolutely got demolished by it. And we're going to see this across all verticals. It's not just electric vehicles. It's not just social media and short form video. The likes of Shein and Temu are penetrating deeply into American fast fashion brands, American online incumbents like Amazon, or even offline retailers like Dollar General. And so I think that necessitates action from the U.S. side to protect those incumbent industries. But it says nothing about the success of those Chinese businesses, which I think are doing very well in their own right. And China, as you know, builds companies that are built for that digital native population, that next generation of consumers. And that's why the likes of TikTok and Shein are doing so well against their American incumbents, which are more built for folks like us that went through this longer retail online evolution.
So Ben, talk to us about the Core Values Alpha Great China Growth ETF. It's got about $8 million in total assets. It's up about 6% year to date. So is the idea of the fund and the opportunity that you're betting on Chinese domestic growth and those Chinese companies that sell domestically, or is it the Chinese company that sells to the rest of the world?
So we do both. We see huge continued demand from the Chinese domestic consumer, and so we're investing in that kind of what we'd call kind of consumption downgrade and reshoring of domestic behavior. And so that includes domestic brands, so domestic cosmetics brands, domestic quick service restaurants, domestic FMCG brands, but also that includes domestic travel and other things that are benefiting from people staying home rather than going abroad. Then, of course, we invest in those cross-border players, both that are integrated on the hardware side, like the BYDs of the world, as well as those that are that I mentioned previously, the likes of Temu and their parent company Pinduoduo, which is doing incredibly well.
Well, but tell me about your cap raise, your fundraising. $8 million in assets doesn't seem like a lot of money under management. So talk to me. We talked last time in February. What kind of flow are you getting in terms of assets? Because it does feel like investors are pretty tentative still.
So again, our background is on the private side where we manage over $2 billion. So certainly by our standards, this is a small AUM as well. I think it is largely driven by American sentiment towards China and particularly global sentiment of folks that would invest in ETFs. And I think we're starting to now see that our ETF, for one of the months of this year already beat the S&P. It's beating all the other kind of China ETFs since its launch as well. And so, but we've still got to see that kind of investor sentiment towards China. And I think that's less about geopolitics and more about returns. If I was an investor today, I would have kept my money closer to home because the NASDAQ and NYSE have been ripping. And there's no reason not to continue to do that, because all the geopolitical noise is irrelevant if the returns are there. And so our belief is that as we're starting to see these markets bottoming, and you finally saw a lot of that capital that was flowing to Japan and elsewhere finally coming back into China, coming back into Hong Kong, I think that rising tide will lift all boats. And then we really like our head-to-head chances against the other China ETFs because we're actively managed, and we also try to filter out geopolitical risk or threats to American national security.
Hey, Ben, China, Carol just mentioned the idea that China, quote unquote, uninvestable. It's a question that we've been asking for a couple of years now, since a prominent bank brought it up a few years ago. And even at Milken this year, one of the panels, one of the panelists was asked, I think it was the CEO of Capital Group, was asked if China is uninvestable right now. What would you say to somebody who argues with you and says, you know what? Given the geopolitical concerns, given the domestic concerns, given what's happening with the government there, I don't believe that China's investable. What would you say to that person?
The numbers would tell you that's not the case, right? So the numbers would tell you that China's growing at about double the pace of the United States. If you're interested in other emerging markets, let's say Southeast Asia, which you guys mentioned earlier on the program, China's in the process of urbanizing people from rural communities and second, third tier cities to the first tier cities. That urbanization alone will generate a customer base that's 2 times the size of Indonesia.
Ben, sorry, I want to jump in real quick because we only have 30 seconds left. Does that growth number even matter if the government can intervene at the drop of a hat?
The government had made changes over the last few years that were more to defend against what they believed were antitrust or other monopolistic actions by large Chinese technology companies. But overall, the Chinese government is still very much growth friendly and is now turned all of its attention on improving global investor confidence in its public markets.
All right, we're going to leave it there. Hey, listen, thanks so much. And again, thanks. We know it's wee hours there in China, so we appreciate you getting up for us. Ben Harburg, founder and portfolio manager at Core Values Alpha, joining us from Beijing. As we mentioned, the Core Values Alpha Great China Growth ETF, about $8 million in total assets. It's up about 6% so far here in 2024.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Go out to some Jersey spot and And whether you're hip or not, the Jersey bounce will make you
Well, New Jersey is known for a lot of things. I think it's fair to say the best tomatoes in the nation. Is that true?
Horse farms, incredible beaches, great public education in some areas.
Bruce Springsteen,
And I was born there.
the Jersey Shore,
I was born there.
Bell Labs, and
A lot of stuff.
Carol Masser's home state.
Yes, indeed.
Our next guest, though, wants to make it known for even more, including the Hollywood of the East, as well as an exemplar for clean energy. We got with us Tim Sullivan, CEO of the New Jersey Economic Development Authority, also known as NJEDA. It's the agency responsible for driving economic growth and development and to create jobs in the Garden State. Tim here in the Bloomberg Interactive Brokers studio. Welcome. How are you?
I'm doing great. Thanks so much for having me over.
Well, thanks for joining us here.
And we should say, just full disclosure, you actually worked with Mike Bloomberg, right?
For is a better word for it.
Okay.
He was the mayor and I was on the staff. But yeah, it was a great career highlight to be part of the mayor's team.
So from City Hall in New York to Connecticut, then to the state of New Jersey.
Back to my home state. When Governor Murphy became governor, got elected in late 2017, I got a chance to come home and work for the home team. Yeah.
So talk to us about not just the biggest challenge when it comes to economic development, but what you see as the biggest opportunity for the state of New Jersey when it comes to economic development.
Yeah, Governor Murphy sees huge opportunities in front of us. You mentioned a couple in the intro, film and TV for sure, clean energy and offshore wind, AI and what that means for New Jersey and what that means for the world. Those are three, huge opportunities that we're attacking pretty aggressively.
I think it's really interesting. New Jersey has also been known, big time for the pharmaceutical industry, but I do feel like a reboot is kind of needed and necessary. Tell us how you see it. Give us the backdrop of what's been going on in terms of economic development in New Jersey and kind of what needs to be done and how you're hoping to change it.
Yeah, one of the big priorities for Governor Murphy is economic diversification. So, pharma and life sciences is still a huge calling card for us. We're home to a huge concentration of, global headquarters and U.S. headquarters for big multinational pharma companies. And we've seen a huge continued surge in that industry, but we want to diversify as well. So film and TV is a great example of that. The motion picture camera was invented by Thomas Edison in New Jersey. Fort Lee was Hollywood before there was Hollywood. We're trying to win it back. And we're not alone in that journey. So Netflix is committed to building a $1 billion production facility in Monmouth County at the old Fort Monmouth. We just announced plans to see another major facility built in Bayonne. There's a developer that's going to build a product called 1888 Studios. 1888 was when Thomas Edison invented the motion picture camera. Yeah. So it's a bit of a nod to our history. And then in the south ward of Newark, right by Newark Airport, is another project by Lionsgate to develop a world-class studio as well. So we're on the cusp of something big, we think.
I was just at Newark Airport early this morning.
No.
So were you.
Yeah, me too. It was a little quiet.
It was a little quiet. Not as quiet when I was there. There was actually a lot of traffic coming into the city when I came in.
Well, that's because everybody was going to work.
Yes, exactly.
Tim, one thing I want to ask, what is taken? I remember early in my career doing a piece about, does it really pay to develop kind of movie entertainment, that industry? Because the tax breaks that are often necessary to bring the business in. Tell us about the business model there.
Yeah, we see huge upside here. It does absolutely require upfront investment. We have a tax credit program that Governor Murphy brought back, which we think is a combination of the most competitive and most progressive. So it does things like awards and rewards diversity, both in front of and behind the camera. But the returns we see on the job side. So, we're going to see, and particularly our incentive program, and this is something Governor Murphy has spent a lot of time making sure we're emphasizing, is encouraging brick and mortar construction, because that's how you're going to get development of facilities that are going to be full all the time. So Netflix is going to build this $1 billion facility. They're going to keep that thing humming. That means lots of permanent jobs, not in front of the camera per se.
It's not just a case of bringing a movie in for 6 months and then having them go.
Correct. Those are permanent careers. And that's not just, that's in film production, but that's in hair and makeup, that's in craft services, that's in carpentry and electrician work and all that, overwhelmingly union jobs as well. So we see huge upside there.
How do you make sure that it's not a race to the bottom, because you're competing with not just New York, which is so close and also very well known when it comes to entertainment. You have big stuff happening in Queens and Brooklyn right now when it comes to this type of stuff, Silver Cup Studios, for example. Sure. And then also in Canada, which is just a huge place for filming movies and TV shows right now. How do you make sure that the incentives that you're offering in the long run are actually beneficial rather than taxing New Jersey?
Yeah, the returns we think we're going to see are significant on the job side. So the permanent jobs that we hope to see be built, and the construction jobs we'll see in the development of these facilities as well. We also see an opportunity to take share from other places as well.
But those jobs don't necessarily lead to economic development if nobody comes and uses those studios.
Oh, sure. Yeah, no, we think
that's what I mean. Like you're competing for every moment there.
Absolutely, but that's why having a partnership with someone like Netflix, who is going to build and develop their own studio and presumably going to keep it full with their own stuff, and they're certainly a partner we're thrilled to be betting on, because we think they're one of, if not the leaders of the streaming kind of revolution and the winners of the streaming wars and all that, and so we see huge permanent job creation opportunities, and then also there's we will continue to have to be on our front foot and be competitive on the tax credit side. Our program, one of the things that's important about our program is it's on the books until 2039. So from a predictability perspective, if you're particularly on the TV side, if you're a showrunner and you hope to do 4, 5, 6, 7, 8, 9, 10 seasons,
right,
which they're all hoping for, our program will be there for them. And
so they understand they have till 2039 that they get those benefits.
Yeah, absolutely, and that's an important part of our marketing. Yeah.
How quickly do the benefits, though? Okay, so there's the benefit outlay. Mm-hmm. How quickly does the kind of payback come to the state of New Jersey?
Payback happens almost right away. That's one of the exciting things about film and TV. You have a movie, even if it is just coming for a couple months to shoot. There's a movie shooting right now that's a pretty high-profile movie that's shooting all throughout the state. They're spending a lot of money. They eat a lot of pizza. They do a lot of dry cleaning.
Come on. Which movie is this?
It's called A Complete Unknown.
Okay.
Timothée Chalamet is in it.
Okay.
It's a Bob Dylan biopic.
Yeah. They're also filming it in New York City.
They filmed a bit of it in New York City, but it's not that we're competitive, but it's more in Jersey than New York. Not that we're competitive.
It's always competitive.
We're really competitive.
Who really owns the statue? Let's just talk.
Statue of Liberty is a Jersey girl.
I know.
You can have an emotional argument some other way, but she lives in New Jersey.
You can't see this. Yes, you can.
No,
see this
I'm in favor of her being a Jersey girl.
I know, but it's like I got I'm surrounded by 2 New Jersey people right here, so
and a California guy.
Yeah, California guy.
Let's talk about alternative energy, renewables. Coming back from Milken, another big theme, and a lot of it has to do with artificial intelligence, all the data centers that are going to be needed to do all of that really kind of amped up computing necessary for AI, machine learning, if you will. A lot of investments going into the data centers, but tell us what the strategy is for New Jersey.
Well, around energy, our biggest initiative is offshore wind. New Jersey has a huge opportunity, and Governor Murphy has set the most aggressive target for offshore wind adoption in America in New Jersey. So we're going to hope to or plan to generate 11 gigawatts of power from off of our shores. That's enough to fuel or power every home and most businesses in New Jersey. So it's a huge incremental energy generation framework, and we're right now net importers of energy.
To power every home and business.
By the time it's enough power to.
How long does it take?
Until we hit that goal, probably 2035, 2040, somewhere in that range. The goal is 2035.
Okay.
And so that's contingent on the development of lots of wind farms over the next decade or two. Governor Murphy has provided all the resources we think these companies need to build these farms, these wind farms, including things like building a port in South Jersey to support the development of it.
What happens if former President Trump wins in November to the state's ambitions when it comes to wind? And here's why I ask. Our own Jen DeLuey's got a story out today about wind farmers bracing for Trump's next salvo as he visits the New Jersey shore. Former President Trump's vocal disdain for wind farms is another worry for developers who've faced high costs and supply chain woes. Former President Trump is going to hold a rally on the beach in Wildwood, New Jersey this weekend, a state that's become the front line for fights over the future of offshore wind.
Yeah, it'd be hard to argue that it'll be helpful to the wind industry. That being said, I think one of the things that we're encouraged by as we think about the future of offshore wind is the folks who are investing in offshore wind are actually the big global energy players. So we have a wind farm that's poised to start construction soon. That's backed. It's called Atlantic Shores. It's half owned by Shell. Right, that is not a fly-by-night concern, nor is it someone who's
it's got its permits, it's all ready
solely
to go.
Committed to clean energy.
Yeah, it's got its permits, it's all ready to go.
It has a few more permits to get through. Those will hopefully happen this year. And so, there's a huge amount of capital that wants to invest in offshore wind. And generally speaking, I think the country has not failed to figure out ways to harness energy that's been out there. This is an industry has been through fits and starts. It'll go through more fits and starts, but we think the 30, 50-year trajectory of this industry and the sector is too important strategically. Again, we're talking about controlling our energy future, not just as a state, but as a country. You're talking about tons of manufacturing jobs, talking about renewable energy and clean energy, there's too many reasons to care about this. So certainly one of the reasons I think our administration's a big fan of the Biden administration's approach on this is that he's all in on wind. We'll see what happens in November, but it's an industry that has been through challenges, and like any new industry that's capital intensive, regulatorily complex, it's going to go through fits and starts. But we think the long-term opportunity for New Jersey, for the Northeast, as far down as Virginia and the Carolinas, by the way, who are also pursuing offshore wind, is too big.
So could be some, starts and stops if we see someone else in the White House or if a turnover. But having said that, you're saying the longer term trends are in place. So even if there's a slow in permitting for wind farms in New Jersey, you're saying, Tim, that longer term, that's the push. You can see it happening.
Yeah, again, I think the rationale for energy independence, for the emissions framework, for the job creation and economic development impact, it's too big. There's too many reasons to like offshore wind to turn our back on it long term. And some of these wind farms that were just approved in New Jersey about 6 months ago are as far as 40 miles off the shore. So unless you have access to the Hubble telescope, you cannot see that from the shore.
I'm a sailor, and for the first time off of Long Island Sound, coming up like on Block Island, like to see them, I really haven't seen them in the past, and it was kind of interesting. I mean, they're way offshore.
They are.
And it's kind of interesting. But
were they spinning?
They were spinning. I didn't get that close.
Yeah, I don't know if you want to get so close.
So
right?
from a distance, but it was like, what is that? And you realize that those are wind farms out there, and you're
It's
seeing
clean
them really
energy,
pop
Carol.
over. Listen, I am full transparency. I'm all in on clean energy.
Hey, one thing that I wanted to ask you about, Tim, was congestion pricing, because it's a huge topic here in New York City. If you walk not too far from here, you'll actually see the infrastructure in place to charge commuters who come into the city in certain parts of it each day when that program is launched later this year. How do you think about that from a New Jersey economic development perspective? Because the governor has made no secret about his opposition to it. Does it affect your world at all?
Yeah, I think I would defer, those comments mostly to Governor Murphy, who's not been shy about his take on this. There's some active litigation underway that is not a good thing for me to comment on. I think it's certainly, it changes the framework of how people think. If it gets more expensive to go somewhere and do something, it gets harder to do it usually. And so, if you're a business in New York City that's thinking about its customers, its suppliers, its trucks, we think it makes New Jersey all the more attractive.
That's interesting.
So I think it's, we'll see how this all plays out. But again, I think the governor's also been clear. He does not oppose congestion pricing, in any form. I think the way this was gone about has met with some concern from him and from our administration. But, he's not a hell no on all in congestion pricing. But I think the way this has been proposed, we think is detrimental to New Jersey from a health and other perspectives. But I think it's certainly, I don't think it's going to be a revolutionary impact on the economic development framework, and the competition between the usually friendly competition between New York and New Jersey and the tri-state area, but it's certainly probably it's a pebble on the scale on our side.
We started, we talked a little bit about healthcare, pharmaceuticals. It's been such a backbone, I feel like, or an important part in terms of New Jersey when it comes to business development. What's new on that front, and what are you seeing? Whether it's AI, again, coming back from Milken and people talking about artificial intelligence, how it impacts things like drug development. So I'm just curious what you're seeing on that front.
Yeah, our momentum in life sciences is really good. Probably the best example of that is Kenvue, who just spun off
It's Friday. You can say anything. We're open to anything.
They just were separated out, whatever the right word is, from Johnson & Johnson.
Spun off.
They did a global search for where they were going to put their headquarters. They chose Summit, New Jersey. We just did a groundbreaking for that new facility that they're going to develop out there. So that's a good example of momentum. So Band-Aids and Listerine isn't going anywhere from New Jersey. And then we've also seen, companies like Eisai out of Japan have made big commitments to New Jersey. Gilead out of the West Coast has built its East Coast headquarters in New Jersey. So not just the, Mercks and J&Js of the world, which we're thrilled to have continue to be headquartered in New Jersey, but lots of new companies choosing New Jersey.
Okay, you know where I'm going to go. We got 40 seconds here. Tim, you're a taxpayer in New Jersey. I'm a taxpayer in New Jersey. Any of these are they going to pay for themselves, or am I going to be looking at paying more taxes?
We think one of the keys, I think, to our long-term success in the state is growing the pie and having more revenue, coming into the state, more jobs, more employment, so that it only provides either the resources to invest in the things we need to invest in, because we're still catching up from a period of underinvestment before Governor Murphy was governor, so things like infrastructure in our schools and our pension system. So we have some catch up to do there on the fiscal side. So I think we'll continue to plow forward on growing as best we can.
Are the taxes high?
That was
Carol?
not a no.
Are the taxes high?
They
in
have
New Jersey
become
for you?
pretty high for me. Tim, this was great. We really covered a lot. Thank you so much. It was interesting. Tim Sullivan, Chief Executive Officer of the New Jersey Economic Development Authority, joining us here in our Bloomberg Interactive Broker studio. You are listening and watching Bloomberg Businessweek. I'm Carol Massar, along with Tim Stenovec, and this is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
That's right, everybody. Check the calendar, man, because Mother's Day this weekend.
I know, it's so bad.
Did you forget?
No, I didn't forget. I'm actually
Okay.
traveling this weekend.
Are you?
Yeah.
Oh, that's right. You're going to be away.
Yeah, I'm going away. I'm going to...
Are you going to go spend time with Mom?
No,
Nice.
I'm not.
Are you actually going to go spend time with...
My wife? No, I'm not. It's bad. It's very, very bad.
Christina, we got to help him out here.
I'm like,
All
I was actually, as I was preparing this segment, I was like, is it too late for me to call Christina and get some flowers shipped to Brooklyn? I don't know. I don't think it is.
All right, Christina Stembel is back with us. She's founder and CEO of Farmgirl Flowers. She joins us from, it looks like gorgeous where you are, Gig Harbor, Washington, just outside of Seattle. So good to have you back with us. It is the Super Bowl of the flower industry. Tell us how important, just remind our folks how important this day is for you guys.
Yes, thanks for having me back, Carol and Tim. And Tim, we got to talk after this.
I think so.
Your wife and Mom. We did just sell out 15 minutes ago. I might be able to make an exception, but this is definitely our Super Bowl, we like to call it, of our year. We do more revenue and more profit in this month than any other month of the year by a significant amount. I think I talked about at Valentine's Day with you. We do Mother's Day is, even more important than Valentine's Day, which really surprises people. We do usually double the revenue, but significantly, sometimes 3 to 4 times more in profit than Valentine's Day because flowers are, better priced around Mother's Day because it's not winter and there's less storms for redeliveries and things like that.
So it costs you less to get the flowers, but the prices are the same for consumers, or is there a little bit of wiggle room?
Yeah, there's a little wiggle room. We can get more varieties now, so we can offer different price points. So some flowers like peonies are still super high priced. We pay usually double before Mother's Day what we'll pay after Mother's Day for the same stems. 1 week makes a huge difference.
Wow.
Supply and demand, right, at its best.
My
but we can get
favorite
more
flower.
Varieties that are peonies is your favorite flower?
Totally.
Yeah. We polled our consumers, 92% of them say peonies are their favorite flower.
I used to grow them. My mom, my grandmother, they're just incredible flowers. I have a statistic for everybody. Consumers are expected to spend $3.2 billion on flowers, while spending on greeting cards is expected to reach $1.1 billion. More money is spent for moms on Mother's Day than dads on Father's Day. That's a lot.
Sounds good to me.
Christina,
it's fine.
What we love is you kind of make the sausage for us a little bit, or tell us what's involved in the flower business. It's not so easy. It looks so beautiful. You get flowers and you're like, that was easy. It's not always easy, though.
No, perishability is so hard. I wish I would have known that back in 2010 when I started Farmgirl. It's so much harder. I wish, I constantly talk about, I wish we sold sweaters so we could even put them on sale in June. But we can't. We have to guess a full year in advance. On what consumer spending is going to be the next year. And as you're just talking about, the markets right now, we have no idea what environmental conditions will be coming into play. This year, most direct-to-consumer businesses are really hurting. And so we're, trying to figure out what should our goal be? What should our projections be? But we have to do that so far in advance. So for this year, we were playing it safe. And thankfully, because we're bootstrapped, we can do that. We don't have to show, huge growth numbers for our investors and board. So I'm so thankful and grateful for that. So we were just, I went into this holiday just saying, if we have a flat holiday, I said this to my team, if we have a flat holiday, I'm going to count that as successful. And we did have a better holiday than last year. So we're definitely counting our blessings right now, but it is such a risk. We always feel like we're standing at a craps table rolling dice when we're putting in those peony orders, 9 months in advance sometimes. We don't know how Mother Nature is going to react. This year actually was the first year in 20 years that we had domestic peonies in time for Mother's Day.
Why is that? Just because of the warm weather we've had?
Yes. Yeah, because with the warm weather, it made them pop earlier. Usually they come on the week after Mother's Day. but that definitely threw a wrench in things because domestic peonies are better than shipping them in from Europe and other locations, but we'd already placed orders further away. So then it's trying to figure out, like, how can we also incorporate some domestic peonies in since we can get them this year very last minute. So
how do you compete with the bigger players on this, Christina? Because let's say, is 1-800-Flowers having the same challenges that you have, for example, or are they able to mitigate it more because of their scale?
Both. I think they have some of the same challenges that are, Mother Nature related or shipping partner related. I talk to our competitors often, and we complain about the shipping delays and things like that we're all trying to figure out last minute together. For our companies, we're not unique in that way. 1-800-Flowers also has those same issues. They don't have their own planes delivering all their flowers. But they do have better, buying power than us. So I'm sure their flower costs are significantly cheaper than us. And they get probably first right refusal on a lot of them as well. So we'll never be able to compete unless we're, doing hundreds and hundreds of millions of dollars. I think they did 2.16 billion company-wide last year. So we're not that scale. But we have some of the same issues and some different ones.
Well, and I also do think about, I'm curious, I want to get your take on how the consumer is doing, because I do think when it's something like Mother's Day, like, we don't skimp typically, but I do wonder, but sometimes there are years that are tougher and you're like, I'm still going to do something, but maybe not as much. So give us an idea of what you're seeing in consumer buying trends for the holiday and maybe more broadly as well.
Yeah, we have found over many years of research on this that people spend more on their lovers than their mothers. So they actually spend way more on Valentine's Day than they do Mother's Day, maybe because they're buying for two of them. They might be buying for a mother-in-law and a mother. So we typically do some lower price point options for Mother's Day, more so than we do for Valentine's Day. And we thought that would be the case this holiday. We thought that people would be going, because the economic climate right now, we thought that lower priced options would be the first to go. But we were wrong that way. We had a lot more people spending more than we anticipated this holiday. That was great, but also bad because we didn't plan for that. So we had a lot more smaller options that were available on our site later, while the bigger ones sold out quickly.
Wow, that's really interesting to hear.
Yeah. Right, because if something changes last minute, you've already had your orders in, right? You can't just call up, I don't know, Costco and say, hey, I need, right? That's not how it works in your business.
Yeah, we're very flexible. So that's something that we are different than the big guys.
Okay.
We're more adaptable than any other company, I think, at our scale in flowers. We're told that by our partners, and we all use kind of the same partners. We change things quickly. We'll sometimes, if one of our partners will call us, one of our farms will call us and say that they have a huge flush of something, we'll be like, okay, no problem. We'll take a photo of it that day with our cell phone. We'll put it on the site and we'll be selling it by tomorrow. Where our bigger competitors plan way further out than we do, and can't kind of adapt to that. So I really like that about our company. We try to stay agile that way.
Hey, Christina, one of the things that we love just about talking to you is how candid you are when it comes to not just the successes that you've had, but also the challenges that you had, especially through COVID and what you saw post-COVID as well. So just give us an update on how the company is doing and how you guys are doing.
Thanks. Yeah, I just tell you straight. I think it's hard. Most people wouldn't say that they consider a flat year a success. I went into this year with our team knowing it was going to be a hard year, and it has been. It's definitely been more challenging. So I kept our expectations really low. Like flat, we'll be happy if we do flat to last year. Really focus on profitability. Everybody's kind of gotten into the game of, having to over discount everything, and then they lose money. And a lot of our competitors, I think, might be in that boat a little bit, spending too much on marketing dollar. Oh, it costs so much to acquire a customer now. So we've just decided, like I said earlier, we can do this because I don't have to report into a board or investors, that we're just going to stay small if we need to, stay flat to last year. We'll even go down if we need to from last year, although thankfully we haven't had to do that yet this year. But really focus on making that bottom line on the spreadsheet black, so we can stay in this long term. So, if we need to be smaller for the next, 2 or 3 years until the economy comes back, we can do that and make it through.
All right. Do I have to send you flowers soon because you're going to maybe sell, or are you going to still go it alone?
Probably still go it alone. I did think, I never thought I'd be 14 years in still talking to you about flower business, because I thought I would have sold by 10.
Duration.
By year 10.
Yeah,
but I've changed my mindset a lot. I think that we don't talk enough about, it's being a long-term sustainable business, and that's a success.
Yeah.
And so I've changed my mindset to be that. We can provide great jobs, tax dollars, things like that.
I got to tell you, I did an interview with the administrator of the Small Business Administration, Isabel Guzman, at Milken, and one of the big things we talked about was viability of small businesses. It's tough. So 14 years and counting, you should feel pretty good about that. So always great to check in with you. Happy Mother's Day, or ahead of Happy Mother's Day. Yeah, good stuff. Christina, thank you so much. Christina Stembel, founder and CEO of Farmgirl Flowers. I always like talking with her.
Yeah, and reminder, everybody, get the Mother's Day stuff done.
Reminder,
sooner
Tim.
than later.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Not like Tim and I are counting or anything, but we've got about 18 minutes left until we wrap up the trading day.
So that's math for you. Look at that.
It's been a packed week, a good week. Feel like we've really picked up on some trends, whether it's in the technology world or the investment world. So let's get to it, because it's a great backdrop for us to dig into it all with Alan Zafran, founding partner and co-CEO at IEQ Capital, joining us from Foster City, California, just south of San Francisco. We were just there.
Yeah, really hot day yesterday, Alan.
Yes,
kind of unseasonably
beautiful.
warm in your neck of the woods. How is it today?
Loving it today. Sunny and warm. It's fantastic. Couldn't be better. It's why we pay the high taxes out here.
Yeah, I was going to say, sounds like a day that ends in Y in California. Carol pays high taxes in New Jersey, but doesn't have the same weather. That's weird.
Yeah, it's a little yicky.
Yeah.
January, February. Still kind of now.
Months that end in Y, yeah.
All right, so what do you make of the month of May? Here we are. It used to be sell in May, go away. And maybe, I don't know, it hasn't happened yet. But we are seeing some upward momentum on the equity side of things here in May. Does it stick for you, Alan?
It sticks for me as long as interest rates don't get too high. And I don't know where the trigger is. Maybe it's a 10-year yield over 5%. But I think what's happened, it's fascinating this year. Everyone's been worried about the Fed's going to cut rates. So it won't cut rates. Oh my gosh, I have to reprice my models. But stocks keep going up anyway. And I think the lesson learned is the economy isn't as interest rate sensitive as it used to be. And there was so much money thrown at corporations and individuals through COVID that it has a lot of pent up cash on the sidelines, ready to buy any asset at any drop. And that's, I think, been the story. And I think it's going to stick through the balance of this year, unless we get rate shocks meaningfully higher. I think that we are going to keep working this way, grinding our way higher.
All right, so meaningful higher, like you said, up above 5%. I think you said on the 10-year. Was that what you said? Because it's interesting coming back from Milken. Most folks were like, if we go up a little bit, if we go down a little bit, in terms of what the Fed does, it's really not going to impact my investment decision. So it has to be something more than that, in your view.
Well, it does. Let's take the economy, okay? On an interest rate sensitivity front, any company or individual who could refinance their balance sheet did when rates were really low through COVID. So as a fact, 40% of homeowners in America do not have a mortgage, and 95% of the mortgages are 30-year fixed. So the notion that rates going up is going to impair people's ability to pay their mortgage is kind of flawed. And a lot of the purchases today are software, it's intangibles. It's not capital leases tied to equipment. So this notion that interest rates are driving behavior, it's not nearly the way it used to be long ago. And then you take into account everybody has already refinanced, and there's still a tremendous amount of money sitting in CDs and treasury bills and money market funds, all sitting and waiting on asset drops to make purchases of assets. So no matter whether you're talking stocks, bonds, even real estate, buyers are ready to buy when and if they feel that prices are at attractive points of purchase. And that's why I think we're in this funny situation that we can watch the Fed all we want. I don't know if it matters that much.
Hey, Alan, one thing I wanted to talk to you about that was really interesting in the notes that you sent to us ahead of time. Thanks as always for doing that. Is you're bullish when it comes to private equity right now. And I think that's a little bit contrarian, especially when it comes to some of the articles that we've seen about private equity in a higher rate environment. We have a Bloomberg opinion piece. It's a video. It's great by Nir Kesar that's just out this week. And it's all about the concerns of private equity in a high rate environment. The idea that there aren't many deals to be had, there aren't many businesses to be bought. The leverage that was typically used in a low interest rate environment is so much more difficult to do nowadays. Why do you think private equity is an opportunity for you and your clients?
Well, of course, it begins on your starting point. But now if you're in a world where the interest rates at which we're starting to place valuations on businesses are higher, that means the discount rate at which I use to discount future cash flows and pushing it back to a present price creates the purchase price to be more attractive or lower. And so I think that, coupled with the fact that bank lending is less available than it used to be, the demise of First Republic Bank, Silicon Valley Bank, and others, has it made it more difficult for business owners to get conventional borrowing. I think there are opportunities for craftful individuals that work at private equity firms who can actually source access to buying ownership stakes in private companies for the right price. There are some incredibly attractive businesses, and in the absence of conventional bank lending, their equity isn't quite as expensive relative to debt as it once was. So I think it's an interesting time to be a buyer of private companies.
Well, that's what, it's interesting at Milken. We talked about that the buyers and sellers in terms of price are coming much closer together, and that's been a big disconnect. And kind of really the sellers are having a reality check of like, okay, here's what we really need to do to maybe have some kind of deal actually happen. Having said that, when I think about the broader investing landscape, why is kind of focusing on the PE area so important to you? Is it because you think there's going to be IPOs? Like, what, more broadly, why is that so important in terms of the broader investment landscape?
Well, I just think in the big picture, private equity is one of many different arrays in which to be invested. So you should always be incredibly well diversified. Cash, bonds, stocks publicly, let alone potentially, if you're a qualified purchaser or an accredited investor getting some private equity exposure or other forms of risk. Public equities have historically generated higher returns than public equities, but it's come along with greater volatility, and there's a greater degree of risk that you end up in the right private equity fund. So you got to be careful about that. But if you think you have access to the right manager and you have a long enough time frame for an investment horizon, now's not a bad time to be beginning to look at that as a potential asset class to put a small portion of your capital.
Accredited investors, yeah, exactly. Although they all PE, private credit as well, would love to kind of maybe even open it up more widely.
I think you talked a little bit about that at Milken.
Yeah.
Yeah, and we talked about that before, Carolyn.
Yeah.
We actually think private credit is a very attractive asset class because private credit is generally priced as a floating rate plus a spread. So today's floating rate,
right,
the structured overnight finance rate, is where the Fed funds basically is at 5.5%. If you throw another 7% on top of that in order to get a loan, you're making loans at 12%.
What do you make of the kind of wall of debt, corporate debt, that's going to be facing the markets, probably starting, obviously next year and then out into 2026 and so on and so forth, the implications of that, especially as companies, private equity or other, potentially have to refinance that debt at much higher rates? Do you anticipate a wave of defaults? And just got about 30 seconds left here.
I think we'll have a slightly elevated amount of defaults, but I think managers that are prudent were well in advance could identify the companies that have those debt maturities that they'll have to be refinanced. And if you're sitting things like private credit, which are floating rate short-term loans, they don't face the debt problems that fixed rate corporate borrowers faced.
All right. Going to leave it on that note. Hey, listen, thank you so much, Alan. Really appreciate it. Alan Zafran, founding partner and co-CEO at IEQ Capital, joining us, of course, there from Foster City, California.
Sunny
as we said.
Foster City.
It sounds pretty gorgeous there.
California.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.